My name is Niccolo de Masi. I'm the CEO of dMY Technology Group. We have 5 SPACs out. 3 of them have closed. Our 4th one's middle of closing, and our most recent one just IPO'd last month, dMY 6. So at the moment, dMY Technology is typically the #1 best performing SPAC franchise in the world if you look at post share price performance. Sometimes Chamath is #1 and we're #2, depends on the week in question, but typically we're battling it out for #1 or #2. And I highlight that simply because it's a sign of the increasing maturity of the space. Everyone in the ecosystem, from the companies going public to the investors to the, I'd say, IPO investors and the initial blank check entity, are looking at post-share price performance as kind of a mark of quality, track record, and success. There are a lot of SPACs in the market today, many more than there have ever been in the history of the asset class or asset category. But what I would say is that in a world of clutter, brand recognition, track record is becoming ever more important. And so what's happening in 2021 that you didn't see in prior years is more reference to league tables. Are you in that top 10 best performing, SPAC teams? If you're not, are you really going to end up being a viable franchise long term? I think what's starting to evolve is the same sort of flight to quality that we've seen in other asset classes over time, and the same kind of brand recognition that we've seen eventually arise for leading venture firms such as Sequoia and leading private equity firms such as Carlyle, Blackstone, or KKR. This is starting to happen in the SPAC space. It will continue to evolve as things mature, and I believe in the long term this ecosystem will have fewer, bigger, better, more proven SPAC sponsor franchises. So there's 3 ways to take your company public. There's an S1 IPO, which is the traditional route with kind of a 2-week roadshow. That's what people refer to in the US when they say a traditional IPO. There's a direct listing. These come and go from fashion, but there's only ever really been 2 pure direct listings, namely Spotify and Slack, that really just said, starting tomorrow, our shares are trading. We're not raising any money, but you can buy and sell our shares. There's a bunch of hybrid direct listings that people attempt using some underwritten share offering coupled with sort of just making your shares tradable. But I'd say that the S4 process, which is what a SPAC IPO is, the S4 process has become an ever larger share of the total paths to the public markets for companies. The S4 process is more flexible. It allows the company more time to communicate with its investor partners. And it also allows for a range of industries and a range of, let's call them, quasi-special situations to come to market successfully. With a traditional S1 IPO, you really only have kind of a binary outcome. Either you are wildly successful and oversubscribed, or the IPO gets pulled and it fails. The S4 process allows for solutions in between those 2 extremes. And whilst there are companies that are very successful IPOs in any mechanism, and there are companies that are very unsuccessful, I firmly believe that the S4 process is here to stay. I believe it solves for a number of use cases for companies, sometimes that are more emerging, sometimes that require more time explaining their proposition, their business model, their unique advantage. And it also allows for different categories of investors to participate also. You see more family offices, you see more strategic investors. And so that backdrop of what your mechanism is of going onto the public markets does at times, I'd say, favor certain industries. You've seen gaming companies go to market through S1s and S4s. There's been no gaming direct listings, for example. You've seen a lot of regulated, gaming, gambling companies come to market through SPAC IPOs. Two of mine, Rush Street Interactive Genius Sports Group are both on that segment. I formerly ran a game company called Glue Mobile in the free-to-play space. That was a traditional IPO back in 2007, but it might have been a SPAC if the SPAC ecosystem had been more fleshed out. I expect as market plays out that you'll continue to see a lot of traction for game-related and gaming companies in the SPAC IPO market because there's a track record of success now, and there's been an ecosystem to develop to invest in these companies, particularly in the United States these days. So the SPAC IPO markets are actually not distinct performers from other mechanisms for taking your company public. If you look at, and we're very proud of this at dMY Technology, if you look at our shareholder base, particularly after the first earnings call, we are proud to have rosters on all of our companies that are probably almost identical with what you'd achieve through an S1 traditional IPO or a direct listing. As a result, company performance is really about company performance. There isn't a sort of SPAC asset class that says you're going to perform better or worse with a SPAC than you will with another mechanism once you've closed. So my favorite mechanism of looking at both SPAC performance as well as any company's IPO performance is post-IPO, post-close share price performance in that first year. That is what matters for investors in the IPO. That is what matters to declare yourself a successful IPO. And we've seen some companies go public using all mechanisms in the past 20 years that shouldn't have been. In the S1 IPO category, there's plenty of businesses that do traditional IPOs that trade far below their IPO price and may never recover. You've had the Enrons and the WorldComs, in the traditional IPO category, back in the day. And we've also seen some, let's just say, suboptimal target company performances from businesses in the electric vehicle space and elsewhere, which have frankly been overly optimistic with their forecasts, as well as overly optimistic about the amount of capital they need to properly fund their business plans. There have been some companies that I think have probably IPO'd on overly aggressive numbers, let's call it miniature numbers of dollars of capital they need to operate their business plan. And we're probably too early from the perspective of mature financial profiles and ultimately a mature management team. That's more to do with the public markets today than I think the SPAC asset class per se. There are many SPACs in the market today. There will probably be a lot of SPACs in the market for a lot of years to come, but you also have to remember that at the dot-com boom, we had about 9,000 public companies in the US. That number shrunk all the way down to something like 3,000 public companies at the trough, maybe 5 years ago. We are building that number back up, and it's something like maybe 6,000 public companies today in the US. Given the growth of the market, I would worry about supply and demand in the public markets once we have more than 9 or 10,000 public companies. But I think you're still seeing continued, I'd say, traction for all sorts of IPOs, continued economic recovery in kind of a post-COVID world. And I'm fairly optimistic that the regulatory framework that is coming into play for SPACs will continue to favor quality players, quality franchises, quality companies. And so this flight to quality you've seen in the marketplace the last quarter or two will continue. Investors will withhold capital from SPAC sponsors as well as companies, underlying companies that shouldn't be going public. And that will be very healthy for the ecosystem. So whilst there has been some adjustment and some evolution this year in what it takes to be a successful IPO, I don't actually believe that there is a bubble, because what is happening is that companies are choosing different paths to become public. But it's the same number of companies going public, whether it's through an S1 traditional IPO, an S4 SPAC IPO, or a direct listing. I believe that the SPAC IPO market share, which I think is, it's a significant minority of total IPOs. I don't know if it's 30%, 40%. I'm sure some quarters it might be as high as even 50%. I think that SPAC IPOs are going to maintain a significant minority of the market share of IPOs. The structure allows sophisticated investors, it allows retail participation, it allows strategic investors, it allows family offices. There's too many pools of capital that are enjoying the ability to participate in IPOs that in a traditional route, they typically are unable to participate. There's also an SEC process underway with Gensler driving more scrutiny of SPACs, and rightly so in a lot of cases. Underwriters, including mine at dMY Technology, Goldman Sachs, have been leading the pack in the last year of driving ever higher thresholds of underwriting diligence. And really, I'd say that the SPAC IPO process at someone like Goldman Sachs has almost converged with the traditional IPO process. That's healthy for the ecosystem. We believe that that is long-term sustainable. And we expect that the flight to quality that we've been seeing this year, particularly in the last quarter or two, will continue right the way through 2022. The difference between the haves and have-nots of SPAC sponsors and successful SPAC IPOs is going to continue and even potentially accentuate. And so I think by the end of 2022, you will start to see fewer new SPACs coming from SPAC sponsors who've never done it before, as the teams that can drive sustained post-close performance, that have ultimately demonstrated they understand how to make the ecosystem function for all participants, are going to have more capital offered to them. And the opposite will be true for people who are learning on the job, not doing a great job, or don't really know what to do. And that will ultimately mean that you'll have probably fewer, bigger, better SPAC sponsors, still maintaining, I think, a significant minority of the overall IPO market in 2023 and beyond.